Welcome to the week that was. Happy Saturday, everyone. It's August 9th, 2025. And just a quick note, last week we started using Saturdays to look back at the news from the last 7 days, just to catch everyone up on the week that was in Bitcoin News Digest. Let us know if you like this weekend format. So this past week in Bitcoin,
Wow.
it was really a fascinating mix, wasn't it? You had these immediate market reactions bumping up against some really powerful long-term changes happening underneath.
That's right. It felt like a real wrestling match between that short-term economic uncertainty and, these quite profound improvements in Bitcoin's fundamentals and, importantly, the regulatory picture.
Okay, let's try and unpack this.
Yeah, our goal today is really to help you cut through all that noise. We want to understand this delicate balance in the Bitcoin market right now. We'll look at how signals that seem contradictory over the past week might actually point towards a clearer path if you know what to look for.
Exactly. So by the end of this, hopefully you'll have a much clearer sense of what really mattered this week and maybe what signals to keep an eye on going forward. Right. So let's kick off with the price. Bitcoin's journey over the last 7 days, it started the week around, $114,000, $114,600.
Yeah, that's right. It had already bounced back a bit from lows just under $112,000 earlier in the month.
And then it sort of pushed past 115K, had a little dip, but then surged past $117,000, settling around $117,200 by Friday close, Saturday morning now. So mostly consolidating.
Exactly, consolidation. And that really shone a light on some key technical levels that, traders were watching like hawks. You had immediate support holding between $111,000 and $112,000. That lined up pretty neatly with the 50-day EMA, the exponential moving average. Lots of traders use that as a key short-term trend guide.
Right, for signs of a bounce or maybe a breakdown.
Precisely. And then as the week went on, a stronger support zone seemed to build up between $112,000 and $113,000. But that big psychological level, the sort of line in the sand everyone mentions, that's still down at $100,000.
Yeah. And on the flip side, the resistance.
Well, initially near $115,295. Then it hit what some called a massive resistance wall, right at $117,000. And above that, you've got another barrier around $120,000.
With the all-time high still hanging out there near 123K from mid-July.
That's the target. And interestingly, you saw technical analysis firms like Investec, they actually shifted their short-term view from negative to weak positive, but their long-term outlook is consistently positive.
Which is fascinating because that technical view contrasts sharply with some analyst opinions, right? You had these really conflicting takes.
Oh, absolutely. You had, say, Arthur Hayes from BitMEX still pointing towards a possible drop back to $100, mostly citing the macro environment.
But then you had others like analyst Bitball looking at that dip to 112K and calling it a perfect bottom.
Yeah, seeing a classic chart pattern, that inverted head and shoulders, and calling for a rally up towards like $148,000. Wildly different outlooks.
So how did market sentiment react to all this, the fear and greed index?
Well, that's where it gets telling. It shifted pretty fast from fear early in the week, then into neutral, and by the end of the week, it climbed up to 62. That's officially greed.
Greed, okay.
Yeah, what's really interesting is how quickly that sentiment can swing, trying to digest all these conflicting signals.
Yeah.
But it's important, like you said, it's greed, but not yet extreme greed.
Right, which some people interpret as meaning there's still maybe fuel left in the tank for more upside before things get too overheated.
Could be. It suggests the market hasn't quite hit that euphoric peak yet.
Okay, so that's the price action and the sentiment. But to really get what was pulling the strings this week, we have to look at those bigger macroeconomic forces, that tug-of-war you mentioned.
Absolutely. And this week served up what we're calling a macro paradox. It was quite something. On one side, you had weaker signals from the U.S. labor market, the non-farm payrolls report. Well, this is pretty disappointing. Only 73,000 jobs added in July, and they revised previous months downwards too.
Right, and that immediately ramps up speculation about the Fed, doesn't it?
Instantly. Expectations for a September interest rate cut just surged. Probabilities jumped to over 90% according to Fed funds futures, which brings up that key question. Why would a weakening economy, which sounds bad, actually be seen as a positive thing for Bitcoin?
Yeah, it seems counterintuitive, but it's that classic relationship, isn't it? A more dovish Fed, meaning lower interest rates and potentially more money printing or liquidity, That historically drives capital towards risk assets, especially non-yielding ones like Bitcoin. If safe investments pay less, the hunt for returns elsewhere gets more intense.
Exactly. Lower opportunity cost to hold Bitcoin.
Right.
But that dovish hope was immediately counterbalanced by rising trade tensions.
Yes, the tariffs.
Right. The U.S. administration announced new reciprocal tariffs, like 35% on goods from Canada, and then tariffs on those specialized ASIC miners coming from Southeast Asia, climbing up past 21%.
And that just spooks the market generally. Risk off.
Pretty much. It created this broader risk-off mood across markets. And in the crypto world, especially in the derivatives market, where people use a lot of leverage, that led to over $630 million in liquidations of long positions, wiped out quite a few bullish bets.
A stark reminder of how tied into global events crypto markets are now.
Definitely. Geopolitics matters.
And just to muddy the waters even more, you had Robert Kiyosaki pushing his Bitcoin August curse idea.
Yeah, the Rich Dad Poor Dad author. He was saying he hoped the price would crash below $90,000 so he could load up.
It's a funny mix of market lore and personal investment goals, but it definitely adds to the psychological noise around price moves.
For sure. It taps into that historical pattern or perceived pattern of August being a tricky month for Bitcoin.
Okay, so moving away from the macro picture and price swings, let's talk institutional players, because this week showed a really interesting split, almost contradictory behavior.
Yeah, contradictory is a good word for it. It really felt like a tale of two different types of institutional money. So on one side, you saw pretty hefty outflows from the U.S. spot Bitcoin ETFs. These funds had a really sharp reversal.
That big outflow day, August 1st.
That was the one. $812 million pulled out in a single day, the biggest outflow in over 5 months. And over 4 days, it totaled nearly $1.5 billion out. You saw big redemptions from funds like BlackRock's IBID, Fidelity's FBTC, ARK's ARKB. It strongly suggests some tactical traders, maybe those who got in earlier, were taking profits after that strong July rally.
Which arguably is healthy market behavior, right? Profit taking is normal.
Absolutely. It shows a maturing market where people aren't just holding forever, they're actively managing positions. It's that fast money maybe taking some chips off the table.
Okay, but then the other side of the coin, the corporate treasuries.
Exactly. In complete contrast, you saw corporations continuing to stack sats, basically. Metaplanet, listed in Tokyo, bought another $53.7 million worth of Bitcoin.
Adding quite a bit to their already large stash.
Yeah, bringing their total significantly. And then Luxembourg's Capital B added more. Jack Dorsey's block revealed they bought another 108 BTC in Q2.
Even the Michigan State Pension Fund, tripling down on their ETF exposure.
It really highlights that difference. You've got the shorter-term ETF flows, maybe more driven by immediate price action, versus this permanent capital corporations making long-term strategic balance sheet allocations. Different mindsets.
And it wasn't just buying and holding, was it? There were some more sophisticated moves, too.
Definitely. Anchorage Digital, which is a federally chartered digital asset bank that's a big deal, they acquired over 10,000 Bitcoin, almost $1.2 billion worth.
Wow.
Yeah, that feels like more than just an investment. It's like a signal, a paradigm shift, with a regulated entity making such a massive long-term bet on Bitcoin as a core asset.
And it wasn't just Bitcoin either.
No, diversification is happening too. Sharplink Gaming, which has Ethereum co-founder Joe Lubin as chairman, they bought another $300 million worth of Ether, becoming the second biggest public holder of ETH. Others are looking at Solana for staking yields.
And using crypto in their actual financing.
Right. Smarter Web Company in the UK raised $21 million through a Bitcoin-denominated bond. They're aligning their capital, raising directly with their Bitcoin treasury strategy. That's next-level integration.
So lots of bullish institutional signals. But then you had Michael Novogratz saying maybe the explosive growth phase of companies adding crypto to balance sheets has peaked.
Yeah, the CEO of Galaxy Digital, it's a more cautious take, suggesting maybe that initial huge wave of corporate adoption might be slowing down. Something to keep in mind for sure.
Okay, this feels like a good point to pivot to regulation because, honestly, the developments this week felt huge, like a potential landmark shift, especially in the U.S.
I agree. This could be the most significant long-term story to come out of the week. It feels like a real move towards a clearer, more functional and even constructive framework for digital assets. And the big one, the headline grabber, was what we're calling the 401k catalyst.
Right, the executive order.
Exactly. President Trump signed an executive order telling federal agencies to start the process of rewriting the rules. The goal, to allow 401k retirement plans to invest in a wider range of alternative assets. And they explicitly included cryptocurrencies.
Okay, let's pause there. What does that actually mean in terms of potential money flowing in?
Well, Ryan Rasmussen over at Bitwise put some numbers on it. He estimated that if crypto captures just 1% to 10% of the roughly $8 trillion currently sitting in U.S. 401k plans.
Which sounds plausible as part of a diversified portfolio.
Right. That could translate to anywhere between $80 billion and $800 billion in new investment flows.
That's a staggering amount of potential capital. Mostly long-term passive investment, too.
Exactly. It's a major policy shift. It legitimizes Bitcoin and potentially other cryptos as suitable for long-term diversified retirement savings, not just speculative trading. And the potential effect could be dampening volatility over time, creating this steady underlying demand floor, almost like dollar cost averaging, but on a massive national scale.
Huge implications. And that wasn't all on the regulatory front, was it?
No, far from it. The Ripple versus SEC saga finally ended. Nearly 5 years, both sides withdrew their appeals. That removes a big cloud of regulatory uncertainty that's hung over the whole market, especially for institutions worried about which assets might be deemed securities.
That's a definite win for clarity.
Then you had the CFTC, the commodities regulator, announcing they'll permit spot crypto trading on their federally regulated exchanges. That's part of this joint project crypto with the SEC. It suggests coordination and a path forward for regulated spot markets.
And the debanking issue.
Yeah, reports that the White House is drafting an executive order to investigate banks potentially denying services to crypto firms, trying to ensure fair access to the financial system. So multiple positive signals just within the U.S.
And it feels like this momentum is global now, too.
It really does. The UK's FCA is lifting its ban on retail investors accessing crypto ETNs from October 8th. That's after 4 years.
South Korea piloting its own stablecoin, KRWIN.
Brazil, a major G20 economy, reportedly exploring adding Bitcoin to its reserves, potentially $17 billion worth.
Yeah.
You have Bitcoin Indonesia pitching the sailor strategy to their government.
Dubai and the UAE aligning their crypto rules.
In France, that proposal to use surplus nuclear energy for state-backed Bitcoin mining. Trying to turn waste into revenue, potentially $150 million a year. It's innovative and shows a real shift in thinking.
It's undeniable, a global move towards figuring out how to integrate, not just ban, these assets. Okay, staying on that theme of institutional buy-in and mainstream acceptance. There was one specific announcement this week that really turned heads, a big name crossing the Rubicon, so to speak.
Ah, yes. You must be talking about Harvard.
The Harvard University Endowment. What did they disclose?
They revealed in their Q2 filings a pretty substantial holding in BlackRock's Bitcoin ETF, IBIT. We're talking $116.7 million worth.
$116.7 million.
Okay.
Where does that rank them among IBIT holders?
That makes Harvard the 29th largest institutional holder of IBIT. And think about it. This is Harvard's endowment, managing over $50 billion. It's famously conservative long-term capital.
So what does it mean when capital like that makes a move this significant into Bitcoin?
Well, it's more than just diversification. That $116.7 million stake in IBIT, it's now reportedly Harvard's fifth largest equity position overall.
Wow.
Bigger than
their reported $102 million stake in the main gold ETF, SPDR Gold Trust. Bigger than their reported stakes in giants like Alphabet, Google, and NVIDIA.
Okay, that's not just dipping a toe in. That's a major strategic allocation. It's a statement.
It absolutely is. It signals a fundamental rethink about Bitcoin's role, its risk-adjusted return potential, maybe its value as an inflation hedge or a growth asset within a traditional sophisticated portfolio. Other endowments will be watching this very closely.
Like you said, maybe Bitcoin's graduated from the dorm room to the endowment fund.
And it wasn't just Harvard. We also saw Brown University, another Ivy League institution, nearly double its position in IBIT, now over $13 million. So it's a trend among these big, influential endowments.
It suggests that perceived career risk for an investment manager at an endowment to allocate to Bitcoin is fading fast. It's becoming more acceptable, maybe even expected.
Okay, so we've covered the price, the macro, the institutional flows, the regulation. Let's get under the hood now and look at the on-chain data, because that's painting a picture of potentially a serious supply squeeze coming.
Yeah, the on-chain metrics this week were pretty compelling, pointing towards increasing scarcity. First off, Bitcoin's on-chain velocity, basically how often coins change hands, it's fallen to a decade low.
A decade low? What does that tell us?
It suggests a deep structural shift. People are holding onto their Bitcoin for longer. It's being treated more like a long-term store of value, like digital gold, rather than just something to trade quickly. Less churn, more HO dealing.
And the number of people holding significant amounts.
Well, the number of whole coiners wallets with at least one full Bitcoin is actually shrinking slightly, just under 983,000 now. It highlights how scarce owning even one whole Bitcoin is becoming.
But the really critical piece for a potential squeeze is the OTC desk inventory.
Absolutely crucial. These are the desks that handle the huge block trades for institutions. Their inventory, the amount of Bitcoin they have readily available to sell, has plummeted. It's down to just 155,000 BTC.
That sounds low. Is it?
It's approaching historic lows. And the implication is huge. If large buyers, like maybe these endowments or corporations, want to buy big, they might not find enough supply on the OTC desks. They'll be forced to go to the public exchanges to source that liquidity. And doing that, buying large amounts on exchanges, can rapidly eat through the available sell orders and potentially trigger sharp price moves upwards. A classic supply shock scenario.
Especially if the existing holders aren't selling.
Exactly. And the data shows long-term holders, who control something like 53% of all circulating Bitcoin, they are largely not selling into this recent price action. Their conviction seems really strong, which further tightens that available supply.
Okay, so scarcity is one part of the on-chain story. What about developments within the Bitcoin ecosystem itself, things being built on top?
Yeah, that's evolving quickly too. The whole Bitcoin Fi space, basically DeFi applications being built on Bitcoin layers, reportedly hit a big milestone. $10 billion in total value locked, or TVL.
$10 billion. That suggests a real shift from just storing Bitcoin to actually using it as active capital within its own ecosystem.
Precisely. It's moving beyond just passive holding. And you're seeing investment flow into the infrastructure for this, like Bitcoin Layer 2 networks. Build on Bitcoin, or BOB, raised $21 million this week. Their goal is to blend Bitcoin security with the kind of DeFi flexibility you see on Ethereum.
Interesting, but not all innovation is created equal, is it? We saw a cautionary tale this week, too.
Yeah, Bitcoin Hyper, a project that raised over $7 million in a pre-sale. Lots of marketing hype.
But some red flags.
Quite a few, yeah. An anonymous team, no clear working product yet, despite the fundraising, vague technicals, and these really high, frankly, unrealistic staking APY claims. It's just a reminder for everyone to do their homework. Hype doesn't guarantee legitimacy.
Always important. What about the miners? Network health looks strong.
Very strong, actually. The network hash rate, the total computing power securing Bitcoin, hit another all-time high, over 952 exahashes per second. And the difficulty level is set for a record upward adjustment.
Which signals miners are confident about future prices, right? They're investing more power.
That's the usual interpretation, yeah. Strong miner confidence, but it's tough for individual mining companies right now. We saw TeraWulf report wider losses. Their cost to mine a single Bitcoin basically doubled compared to last year, up to around $45,500. And CleanSpark is fighting a potential $185 million tariff bill on their imported mining gear because of those new trade rules.
So the network is strong, but the economics for individual miners are challenging, especially post-halving and with these new costs.
Exactly. It's a competitive, capital-intensive business with thin margins for many right now.
And just before we wrap up, one more sign of Bitcoin hitting the mainstream this week, the Financial Times.
Yeah. Front page feature in the FT discussing exactly this trend of public companies putting Bitcoin on their balance sheets. When a story like that hits the front page of the FT, the conversation has shifted firmly into the established financial world.
It's definitely not a niche topic anymore.
Not at all. So if we try and pull all these threads together from the week, what do we see? I think the overarching theme is this period of profound tension. You have the short-term price bouncing around, largely reacting to that macro noise, Fed hopes versus tariff fears, healthy consolidation, arguably. But underneath that surface noise, the long-term foundational data, the regulatory clarity emerging, the steady institutional accumulation, Harvard's big move, the shrinking on-chain supply, it all points towards a pretty robust bullish setup for the longer term.
Yeah, it really underscores the importance of trying to differentiate between that short-term noise and the longer-term signal. And maybe that's why you see these increasingly bold price targets coming out from Wall Street analysts now. Standard Chartered talking $200 K, Tom Lee at Fundstrat saying $250K, even Canary Capital mentioning $300 within this cycle.
Right. They might sound extreme in isolation, but when you view them through the lens of this potential supply squeeze, meeting new waves of demand from ETFs, maybe from 401ks down the line, plus the global regulatory green lights, they start to seem more plausible, at least directionally.
So looking ahead just into the rest of August, what should people be watching out for? What are the key events?
Well, definitely keep an eye on the macro calendar. The U.S. Consumer Price Index, the CPI inflation data, that's out on August 12th. That will heavily influence what the Fed does or signals it might do.
And the Jackson Hole meeting later in the month.
Yeah, the big central banker get-together, August 21st to 23rd. Fed Chair Jerome Powell usually gives a key speech there, hinting at future policy direction. That could definitely cause some market ripples.
And technically, those price levels we met.
Still key. Watch that $110,000 to $112,000 Beria for support. And on the upside, breaking through that $117,000 to $120,000 resistance zone would be a very bullish signal.
Okay, so wrapping up, this week really felt like a crucial transition. Bitcoin's perception is clearly shifting, moving away from just being a speculative digital token towards being seen as a legitimate part of institutional portfolios, maybe even retirement plans. That price stability we saw, that consolidation, maybe it's not weakness, but actually the sign of a market maturing, methodically absorbing all this huge news and building a stronger base.
I think that's a great way to put it. This consolidation phase, it looks quiet on the surface, but it feels like a new foundation is being laid underneath. Which does leave us with a big question, doesn't it? As Bitcoin gets more and more integrated into traditional finance, as we saw this week, will its infamous volatility actually start to lessen over time? Or will its growing correlation with traditional markets just mean that this macroeconomic tug-of-war we talked about gets even more intense?
That is the big question indeed, something for all of us to think about. Well, thank you for joining us for the week that was. We hope this breakdown helps you feel a little more informed about everything that happened. We'll catch you next time.